Welcome back. Today, we're digging into Northpointe Bank shares, ticker NPB. So, their Q3 earnings just dropped, and honestly, on paper, it looked like an absolute home run. I mean, we're talking great growth, solid profits, the whole 9 yards. But then, you look at the stock and what happened? It actually dropped. So what's the deal? That's exactly the puzzle we're going to unpack today.
All right, here's how we're going to break it down. First, we'll hit those headline numbers, the beat and the dip. Then we're going to pop the hood and look at their growth engine. After that, we'll get into the guidance and some of the headwinds that might explain the market's reaction, and we'll wrap it all up with our take on what's next.
So yeah, let's get right into it. The beat, but the dip. This is really the core contradiction we've got to figure out.
I mean, seriously, when you look at the fundamentals, everything looked great. You had strong loan growth, strong deposit growth, profitability was looking really, really solid. This is the kind of stuff that, as an investor, you get excited about. And yet, crickets. The stock just couldn't catch a bid. So what gives?
Okay, let's put some meat on the bones here. Look at these numbers. GAAP EPS came in at 57 cents. Return on assets, 1.34%. And return on tangible common equity, this is a big one, over 15%. Now you got to understand, in today's banking climate, these aren't just good numbers, they're fantastic numbers. These are the kind of figures that should have sent the stock soaring.
And there it is. That's what the market thought, down 1.2% on the day. So you have this stellar performance, real banner quarter, and the stock goes down. This is the disconnect, right? This is what we're here to figure out.
All right, to get to the bottom of this, we really have to look under the hood. What is actually powering Northpointe's growth? Well, it really boils down to two key programs that are just firing on all cylinders.
First up is their Mortgage Purchase Program, or MPP for short. Now this isn't your typical old-school banking. Think of it more like a high-tech platform that lets them systematically buy up mortgages from bankers all across the country. It's a really slick way to generate both loan growth and, importantly, fee income.
And just look at the sheer scale of this thing. $9.8 billion. That's how much they funded through this one program in a single quarter, a record high. I mean, let that sink in for a second. That is an absolutely massive amount of volume.
And hey, don't just take my word for it. The CEO, Chuck Williams, was all over this on the call. He called the MPP performance exceptional and then pointed right to their other big growth driver, the all-in-one loan, which is growing at a red-hot 23% annualized pace. The momentum is just undeniable.
So you can see this wasn't just a one-trick pony. We're talking about a really powerful 1-2 punch. Total loans are up 35% year over year. And check this out. Total deposits are up 35% too, matching that growth. They're funding it well, adding over $300 million in what they call custodial deposits. That's the good, sticky stuff, just this past quarter.
Okay, so if everything's so rosy with the growth engine, why on earth did the stock fall? Well, this is where we get into the other side of the story. It's all about the guidance, or maybe the lack of it, and some pretty serious headwinds that came up on the call. This is where you can feel a caution setting in.
And it really comes down to this classic tug-of-war. On one side, you have management's story, right? The bull case. They're talking about keeping this awesome growth going, improving their funding, protecting their profit margins. It sounds great. But on the other side, you've got the market's perspective, the bear case. And they're seeing no hard and fast numbers for guidance. They're seeing costs going up. And this is a big one. They're looking at the absolute mess that is the broader regional banking sector right now.
So naturally, the analysts on the call jumped all over this. This is kind of the million-dollar question for any bank right now. What happens to your profits, your net interest margin, or NIM when the Fed starts cutting rates? It's the key thing everyone wants to know.
And to his credit, the CFO gave a pretty detailed answer. He's seeing the NIM landing somewhere between 2.45% and 2.55%, hopefully toward the high end of that. The good news? They're getting rid of old, low-rate loans and replacing them with newer, more profitable ones. The bad news? Their entire forecast is built on the idea that the Fed is going to cut rates 4 times next year, and that's going to put pressure on everyone's margins.
All right, so let's put all the pieces together. What's our take here at Talk Tickers? Here's how we're looking at Northpointe heading into the next quarter.
We're kicking off our coverage with a market perform rating. Now, what does that mean? Basically, we think the stock is going to trade right alongside its peers and the rest of the market. Not a big winner, not a big loser, just in line. So here's the thesis in 3 simple steps. 1, we think Q4 is going to look a lot like Q3. Great loan growth, but their margins will feel a little bit of a squeeze from costs and the rate environment. 2,
The stock itself, probably going to be stuck in a range, just moving with the rest of the regional banks. And 3, the reason why, the company is doing a great job, but they're swimming against a really strong tide of macro uncertainty. So for now, it's a wash.
And look, this chart right here pretty much tells the whole story. Over the last month, Northpointe is actually down more than the regional bank ETF KRE. It just goes to show you, even with a great quarter, the sector sentiment is what's really driving the bus right now.
So how could you play this? Well, one idea is what's called a pair trade. It's a bet on relative performance. You'd go long Northpointe stock and at the same time short the regional bank ETF. The idea here isn't to bet on which way the whole sector goes. It's to bet that Northpointe, because it's run so well, will do better than its weaker competitors, whether the market goes up, down, or sideways.
So let's wrap this up with the key takeaways. Q3 was operationally awesome, thanks to those MPP and AIO programs. But the stock got no love because of those sector-wide headwinds and rising costs. Management sees growth continuing, but they're bracing for that margin pressure. And that's why we're at Market Perform. It's a great company in a really tough neighborhood.
And that really leaves us with the one big question you have to ask yourself as an investor. Is Northpointe's growth engine, this unique thing they've built, powerful enough to finally let the stock break free from the rest of the banking sector's problems? That's the billion-dollar question. That's what we'll be watching.
And as always, just a quick reminder for everyone, this is not financial advice.